Last Sunday, I told you I was keeping roughly 28% of my portfolio in cash. And I said I was watching three things very closely: oil, Powell, and AI spend. Now we're midweek and the results are coming in. Oil got worse. Powell did not rescue the market. Nvidia wowed the room, which was to be expected.
Nope. Hey, tell you what.
And Micron had some great results, but the market did not turn around. And in fact, it's continued to trade lower this week. So no, I haven't used the cash I'm holding in my portfolio. And there's also another piece of news this week that makes one of my biggest holdings, Amazon, a lot more interesting than people realize. Welcome back to the Liam Hyland Portfolio. I'm Liam, a chartered accountant that's documenting the build of a real portfolio in public. This is not financial advice, it is just my analysis of stocks that I own. Today's episode is a direct follow-up to the one I posted before the market opened on Monday. I said I was staying patient, and I gave you the three exact things I was watching before using any more of my cash. And so far, the results have not given me the green light. Let's start with oil, because oil is still the biggest problem in the room. Last weekend, the market was worried. Midweek, it has much better reason to be worried. Brent crude has spiked above $119 a barrel after Iran struck energy facilities across the Gulf. And that is exactly the kind of move I was worried about for this portfolio. Because once oil starts behaving like this, it is no longer just another headline. It starts bleeding into everything else in the market. Inflation, growth, valuations, and even consumer confidence, all of it. Unfortunately, oil is like smoke getting into every room of the house. Once it spreads, even the clean assets start smelling like the fire. So signal number one did not improve. In fact, it's only gotten worse. Second was Jerome Powell and the Fed. And this one matters a lot for my portfolio because I own a lot of companies that do best when the market believes the future will be cheap to finance and richly valued. The Fed held rates steady, and that part was to be expected, but we didn't get the kind of reassurance we wanted.
How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You know, you can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is it's completely out of our hands, and we just, like everybody else, we have to just wait.
And so while the Fed kept rates unchanged, it's lifted its inflation outlook and still only pointed to one cut this year. And if you watch Powell's press conference, he was clearly not there to give growth stocks some big green light. He did not come in and calm everyone down. He basically told the market that higher energy prices and sticky inflation are still very much on the table. So again, signal 2 didn't improve either. But there is some positive. And the third point was the AI spend and broader ecosystem. And this is where it gets really interesting because the headlines were strong, which was to be expected, but the market standards are clearly getting tougher.
Now, I don't know if you guys feel the same way, but $500 billion is an enormous amount of revenue. Not one impressed. I know why you're not impressed, because all of you had record years.
At Nvidia's GTC conference, Jensen Huang made some huge statements. He said Blackwell and Rubin chip revenue could top $1 trillion by the end of 2027.
A very high confidence demand and purchase orders for Blackwell and Rubin. Right here where I stand, I see through 2027 at least $1 trillion.
So yes, the long-term demand still looks enormous. And while I don't own any of Nvidia shares, this is still obviously relevant for a portfolio like mine, because I own companies tied directly or indirectly to that AI ecosystem. Microsoft, Alphabet, Amazon, and Meta. These are all businesses the market has been treating as either beneficiaries of AI, funders of AI, or both. So yes, Nvidia impressed. But here's the important part. It did not suddenly turn the market around. And you can see that very clearly in what happened with Micron this week. Micron beat expectations and guided strongly, and still got sold off because investors focused on the fact that capital spending is going even higher. That tells us the market is being savvy here because they're not just clapping for every company that's now putting A and I in any of its branding. It wants more. It wants to know exactly what that spending bill looks like. It wants to know how long that payoff takes. And it wants to know whether this capex actually turns into any durable returns. Now, let me bring this back to my own portfolio. Earlier this month, Amazon's AWS facilities in the Middle East were hit by drone strikes, causing power and connectivity issues, forcing customers to shift workloads to other regions. So this is not some abstract thought experiment anymore. This is actually happening. And someone asked me a good question in the comments, which was what my thoughts are on the AWS servers getting blown up in the UAE, and whether I think Amazon will exit the region. Right now, my view is this. I do not think this is an exit story. I think it's much more of a resilience story, because the bet I have on Amazon includes the physical infrastructure that it has in play. The data centers, fiber, the transformers, and the power, and the geography. And in some parts of the world, that obviously exposes it to severe geopolitics. So if AWS infrastructure in the Gulf can be disrupted, that does not automatically break the Amazon thesis for me, but it does make the thesis more real. It reminds us that cloud infrastructure is not some floating magical vacuum. It is supported by real-world infrastructure, and the real world can get messy. And despite that, for me, it doesn't make Amazon less interesting. If anything, it makes Amazon more interesting. Because one of the things that separates strong businesses from their weaker counterparts is how well they handle stress like this, how well they can reroute, how well they can recover, and how well they absorb unexpected shocks without the long-term thesis breaking. So when I look at Amazon right now, I'm not looking at this and thinking, right, they need to leave the region. I'm looking at this and thinking, how strong is the business? How quickly can it recover? And does this actually change the long-term case? And right now for me, the answer is no. It does not change the long-term case. I have not seen any evidence that Amazon is exiting the region. What I have seen is AWS managing the disruption, customers recovering, and Amazon still pushing ahead with major infrastructure investment in the Middle East. Now, what am I actually doing with my portfolio? Very simple. I am still not panic selling, and I am still not deploying the cash and buying the dip, because the three things I have told you I was watching, they just haven't improved enough. Oil has worsened, the Fed has not become more supportive, and the AI spend is still in that awkward phase where we're getting great technology, but it's colliding with that investor fatigue we've been seeing in this weaker market for some time with all this large capex spending. This is exactly why I kept such a significant part of my portfolio in cash. Not because I think I can time the exact bottom, not because I am bearish on everything, but because when the market is changing character, I want that flexibility. I love having that ability to wait, that ability to be selective. And I want the ability to buy when the odds improve, not just because something is cheaper than it was a few days ago. And so the cash I hold in my portfolio gives me the breathing room to remain calm and think clearly. Now, let me tell you what would actually make me buy. Firstly, oil needs to calm the hell down. It does not need to collapse, but it needs to stop behaving like a flamethrower. Secondly, I need to see that quality tech companies can absorb bad macro news. Right now, the market is hypersensitive to broader news regardless of business fundamentals. We've seen that being the case time and time again with many great companies currently trading at their 52-week lows. That is important to me because it's telling us that the market risk appetite is still weak. It's not off, it's definitely on, but it's far more selective. And thirdly, I want to see whether the AI spend narrative can hold together without every strong number, every earnings beat, every strong guidance still getting punished because of the capex spend. If I start seeing those things improve, then I can get more constructive with the portfolio. And the names I'd feel best about leaning into are still the higher quality core holdings. But until then, patience is still the correct position. And I want to get your honest view on the Amazon question because I think it is one of the most interesting debates in my portfolio right now. If AWS infrastructure is being physically disrupted in the Gulf, does that change your Amazon thesis at all? Yes or no? Let me know in the comments because I want to know how other investors are thinking about this. So that's the recap. The market is not giving me the all clear. If anything, it has told me the same thing I was already thinking over the weekend, just a bit louder. And for now, the cash stays where it is. In fact, it will continue to grow and take up even more of my portfolio until such time that these dynamics start to improve. Thanks for watching, and I'll see you in the next one.